So I see it time and time again, people saying they got their car for free, property pays for their car. What does it mean? Can you actually get a car for free? The answer is kind of yes. Whether you're a small business, a property business, all of this applies to you. So make sure you watch the full video.
Hey, what's up? My name's Samuel Leeds, and in this video, I'm going to be interviewing a tax specialist, a property accountant, where we're going to be talking all things tax, from capital allowances, stamp duty, should you buy through a limited company or as an individual, group structure, what you can claim as expenses, what you cannot, all things tax. Use this video, refer to it regularly. You're going to find this really, really helpful in your property journey. So firstly, I just have to say, thank you so much, Joshua, for coming on the show.
Yeah, my pleasure. Thank you very much for bringing me on here. Hopefully going to share so much fantastic content today.
Yeah, now you're quite a young guy.
Yeah.
But just give me, before we kind of start hitting them with the nuggets and stuff, give me a 1 minute insight to your background and your story.
Yeah, definitely. So basically trained as an accountant, been doing accountancy for the past kind of 6 or 7 years now at least. All the qualifications, and about 3 years ago I founded JSM. So we're a firm of property specialist accountants. So all we work with is property investors like yourself and your audience.
Yeah.
So and I'm a property investor myself, definitely mention that because I know what it's like being a property investor, so we can give a better service to our clients.
It's so important. And a lot of accountants don't understand property investment.
Yeah.
And it's great. I love your story as well of how you were an accountant and you saw how much guys like me were making.
Yeah.
Right?
Yeah, watching YouTube. Wow, he's made how much?
Yeah.
Let's get on that.
And then it's like, I want to do that now. So
Yeah.
you're a property investor, but you're an accountant first.
Yeah, 100%.
And I always say I'm a property investor first, and the tax stuff comes second. For you, it's the other way around.
Yeah.
But it's been great seeing your videos, the content. Got a lot of mutual connections. We've also been friends now, I don't know, a couple of years.
Yeah.
Loosely. And so all right. First big question is limited company.
Yeah.
There's so much talk around this. Please tell me, if you're buying a property, if you're new to property, should you set a company up or should you just buy it as an individual?
I suppose the easy answer here is it depends.
Right.
It depends on so many different things. But I'm going to run through a couple of them of kind of what you should be aware of and what you should take into consideration. The main thing is what you're looking to achieve through property and kind of where you are now, where you want to get to. So if you're in a job now, you're earning kind of good money, and by that I mean you're almost a high rate taxpayer, so you're earning kind of £30,000-40,000 potentially, and you're looking to build a very large property portfolio, and you're not looking to leave your job, so you're looking at long term, 20, 30 years away, before you actually start taking this money out, you don't need to live off, you're happy in your job,
Yeah.
then based on that you're going to be better off in a limited company, because your mortgage interest is going to be fully tax deductible, you don't need the money to live off, you'll pay corporation tax at 19% on the profits. Whereas if you do the flip side of that, say for instance you hate your job, you just want to be financially free, you want £3,000 a month to live off free property, and then you can tell your employer, see you later.
Yeah.
If that's more like you, you're probably going to be better off in your own name because mortgage rates are cheaper. And as long as you're not a high rate taxpayer or near the high rate taxpayer mark, the Section 24, which you're going to come on to, isn't really relevant to you because you're going to still get 20% tax credit on your finance costs.
Right. And for anyone that's watching this thinking, what the heck are you talking about?
Yeah.
So Section 24, which came in just a few years ago, what is Section 24?
Yeah, so it's called Section 24 because that's the part of the legislation that it represents essentially. And broadly, prior to Section 24 being introduced, all of your finance costs were treated just like any other cost in business. So it's fully tax deductible. So when you're paying your letting agent £100, that comes off of your profits, and the lower your profits, the less tax you pay. Whereas now that's changed slightly, and finance costs are not tax deductible in that way of shape at all. So if you've got £100 worth of profits, usually you would take off your £50 worth of finance costs, leaving you 50 quid profit on which you'll pay tax.
Right.
Now what happens is that £100 profit, you get no tax relief for your finance costs initially, so you pay tax on that £100. If you're a higher rate taxpayer, you'll pay £40 tax on that, being 40%. Whereas now what also happens is you get a 20% tax credit on your finance costs. So on that £50 worth of finance costs, you get 20% being a £10. So you're actually £10 worse off in that example.
Yeah.
That's a very simple way of looking at it. And it kind of shows there that if you're a high rate taxpayer, you're not getting tax relief, which is where limited companies have become so much more popular.
I think as well, the key is to know the differences, to know the pros and cons, but then ultimately go to an accountant and say, look, what do you think's best for me? But it's really good when you can have an intelligent conversation with your accountant rather than just be like, oh, I don't know what I'm doing.
Yeah.
And I think for me, maybe this isn't the case for you, but for me, I'm usually the guy coming to my accountant saying, oh, maybe we could do this, maybe we could do this. I'm pushing the boundaries.
Yeah.
And then the accountant's just the person that's kind of telling me if that's legal or not.
Yeah.
I mean, you're very, very, very creative. So, which is great, and you're a property investor as well. Talk to me a little bit about group structure, and I needed a video about this.
Yeah, so kind of a lot of people that are just getting started, they often set up a limited company, especially if they're doing high cash flow activities, because a lot of people start off doing that, maybe rent to rent and other strategies like that, with the goals of build up that asset base, doing developments later on down the line.
Yeah.
And a lot of people kind of set these companies up and they're not well on the best way to structure it, so that later on down the line you can use the wealth that you've created in your cash flowing company to fund your developments, to fund your property investments. Whereas usually you could loan them between the companies. If you had £100,000 worth of profit in your deal sourcing company and you wanted to use that to buy a property, what if you were to do an intercompany loan from that company to your asset holding company, for instance? From a tax point of view, there'd be quite a few problems with that, because if you wanted to write the loan off, repay it, from a tax point of view, you pay tax in one company, you might not get tax relief in the other, whereas having that group structure in place allows you to move the money around, move assets around as well. So if you've done a development, you want to keep the properties, move it around without capital gains, stamp duty, potentially even no corporation tax as well, just because you've got that group structure in place.
Yeah.
Whereas if it was you that owned the shares in all the companies 100%, none of those reliefs are available.
Yeah.
So if you're starting out, when you are looking to build a serious business empire, using cash flow companies to fund the asset holding companies, definitely look at a group structure, because it's going to save you a shed load in tax later on down the line.
Right. So you've got your company that makes money,
Yeah.
which is a trading company,
Yeah.
which is going to, and then you're going to have a company which is going to hold wealth.
Yeah.
Right. So what about someone that wants to do rent to rents, but then they also want to do deal sourcing? Would you recommend they have a separate company, or would you?
Yeah, absolutely. Try and keep that separate as possible.
Why?
Simply because, especially rent to rent, if you're doing rent to rent HMO, from a VAT point of view and even a tax point of view, that's still taxed as property investment.
Yeah.
So even though it's rent to rent, it's taxed as property investment, which is on a tax return is completely separate. So you need to do two sets of accounts essentially to actually let us do that tax return from an accounts perspective. From a VAT point of view as well, deal sourcing, that's VATable. Rent to rent HMO isn't.
Yeah.
So if you were to say buy something, a piece of equipment, a laptop or something, because you've got exempt supplies and taxable supplies, some of your VAT would actually be blocked where your turnover relates to the exempt supply. Whereas if you had two separate companies, just put all of your machinery through that, or your laptops or your phones and stuff like that, where you claim all your VAT back, then you leave your rent to rent HMO company as it is, where it can't reclaim the VAT.
Yeah.
So overall, you're going to be able to reclaim more of that from HMRC.
And I'm sure some of the viewers are like, what?
Yeah.
What? You know, so maybe they have to rewind and watch it back a few times. VAT, you mentioned VAT. I've got some of my students that are doing deal sourcing.
Yeah.
And they're packaging and selling deals, and then they're successful.
Yeah.
And within about 6 months, they're like, holy moly, I've hit the VAT threshold.
Yeah.
And then they say to me, could I maybe set up another deal sourcing company and then another? And I'm like, no,
Yeah.
just accept that if you want to be a big company, you want to be a big player, you're going to have to go VAT registered at some point.
Yeah.
And if you're VAT registered, it means you can claim that back from lots of stuff as well.
Yeah.
So talk to me a little bit about VAT. Because some people might not even know what it is.
Yeah.
What does VAT stand for?
So value added tax.
Okay.
So essentially it's a tax on sales that you make. So all of your outputs, essentially, outputs is the technical term for sales. So on all of those, where it's a standard rate of supply, you have to charge VAT at 20%. There are reduced rate supplies as well, so 5% certain things, and some are actually zero rated or exempt. So if you're kind of selling products as deal sourcing, you have to charge 20% VAT. So if you usually sell a deal for £3,000, if you want to keep your profits the same, you have to add VAT on top of that, so the end customer pays £3,600. But on the flip side, you can then reclaim VAT on all of your inputs. So if you've got offices, telephones, laptops, all of that kind of stuff, that will also have VAT on it at 20%. So you can reclaim that back.
It kind of evens itself out then, really.
Yeah.
And people that try and put off becoming VAT registered.
You've got to accept it to grow your business. A lot of people kind of say, I don't want to go VAT registered, I'll just stay below the £85,000 mark.
Yeah.
But that's such a limiting belief. It's almost damaging to their wealth and their success.
Yeah.
Whereas, you know what, go VAT registered, accept it as part of doing business. But then if you've got £500,000 business, paying your VAT, it doesn't matter if you're making that much more
So
money.
true, Joshua. And for me as well, when I started out in business, I didn't understand tax at all.
Yeah.
I didn't know anything about tax. Growing up as a kid, no one taught me about tax. I'm going to make my kids pay tax, even if they get pocket money. They're going to put a bit aside for tax,
Yeah.
just to get into the habit of it,
Yeah.
to put money aside for tax. And I used to just be of the mindset when I started out in business, we're about making money, not about
Yeah.
saving the tax. I changed my mind when I got hit with a 7-figure tax bill. When I started paying 7 figures tax,
Yeah.
I'm like, okay, I'm not happy about this. I need to now get smart. And I personally think there's two extremes of people. There's some people that are obsessed with trying to save money.
Yeah.
And they're like, I don't want to hit the VAT threshold. And they remind me of people that are, you know, when you go to university and then you're like, I don't want to pay it back, so I'm just going to stay at a job for less than 24 grand a year forever. It's like, no,
Yeah.
grow and just pay back your thing. Grow, get VAT registered. But then there's other people that are reckless and don't care about tax and don't worry about saving money, who are also stupid because they end up paying like loads and loads in tax.
Yeah.
What would your advice be to somebody about how much time and energy and effort they should put into understanding tax?
Yeah, I'd say you've got to have at least a good understanding, because still accountants out there that don't really understand tax too much, that aren't going to give you the best advice. You need to spend some time learning about tax, especially if you want to grow your business yourself. Fundamentally, you've got to be your own accountant. Large companies, they're finance directors. For a small company, like most people have, you need to basically be that finance director. So you need to learn accountancy and have a good understanding of profit and loss balance sheets. You need to learn about tax. That said, you shouldn't focus on it too much, because fundamentally, your priority is making money.
Yeah.
But making money has got to be number one, but then keeping and maximising the amount of money you've got left after you've made it is number two.
Yeah.
So that is the way you do that, is through clever accounting, making sure you understand where all your costs go in, reviewing your management accounts and saving tax.
Yeah.
So that's the way people should look at it.
What's the difference between tax avoidance and tax evasion?
A good quote about this is, what's the difference between the two? The thickness of a prison wall. Because tax avoidance, that's legal. Tax evasion is illegal.
Right.
So if you're doing tax evasion, you're going to go to prison. Tax avoidance is basically where using means that are perfectly legal to minimise the amount of tax you pay.
Yeah.
So always avoid tax, never evade it.
Right. So evasion is where you're illegally not pay
Yeah,
tax.
so that's where you're not disclosing stuff. You've got assets offshore, you're not disclosing them to the authorities. Cash in hand work, that's tax evasion. So if you're taking cash earnings and not reporting them, that's the stuff that HMRC come after you for and can result in criminal prosecution.
Yeah, but then avoiding tax, I actually think that the system almost doesn't want you to pay tax in a way, because they give you incentives.
Yeah.
Like, for instance, electric cars. I mean, dude, talk to me about electric
Yes,
cars.
well, yeah, the government kind of do stuff that supports their agenda. Obviously, they're not happy with the CO2 levels and the emissions going on, so they want more people to be in electric vehicles.
Yeah.
The way they do this at the moment is to drive people to go through the tax reliefs that are available. So electric cars have been tax efficient for the past couple of years, and they still are. Broadly, if you buy an electric car for your company, brand new Tesla, Porsche Taycan, something really nice like that, £80,000 car, you can fully write that off as a company expense, meaning you get full tax relief on that, and then you can drive that around personally and pay next to nothing in tax. So Porsche Taycan, the benefit in kind, which is the tax that applies where you use a company vehicle for your own purpose, is about £800 a year, being 1%. So for a basic rate taxpayer, you're going to pay 160 quid a year in tax for driving around a fully tax deductible electric car.
Incredible. It's almost like it's a free car.
Yeah.
I mean, we're getting an electric car at the moment, which should be coming in the next couple of weeks. And I'm pretty sure even the insurance is tax deductible.
Insurance, servicing, tyres,
Everything.
absolutely everything.
It's almost like a free car.
Yeah.
It's just when you've got a company that's making money and you're having to pay taxes, which is incredible. Talk to me about some of the things that people should be doing and claiming back, because I think one of the biggest things people make mistakes on with tax is they don't know what they can and what they can't claim back or write off as tax deductible. So you recently did a very interesting post on Facebook of you and some of your staff, and you were having a nice barbecue. It was a hot day of the year, and it looked like you were just having a nice party and having a nice barbecue, but actually you weren't. You were having a work barbecue. And you said in your post having a tax deductible barbecue, so you're able to claim back the barbecue. And I was like, this dude, like, talk to me about some of the different things that you can claim back. Maybe people don't know, they're not aware of.
Yes, 100%. My rule of thumb is a lot of accountants maybe say, yeah, you can't claim this, you can't claim that. They're very kind of negative. I always say, well, try and claim as much as possible. If I can't think of a reason, or there's nothing, the HMRC legislation that says we can't claim it, let's claim it.
Yeah.
The barbecue is a fantastic example. So the way that was, each year as an individual working for a company, you've got something called an annual events allowance. So it applies to Christmas dinners, anything that you deem, so anything that management says an annual event. £150 a year. So you can use, say, £50 at Christmas, £50 in the summer. However you want to structure it, it's absolutely fine. And broadly, when you use that, it's fully tax deductible in the company. So all of the costs of everything, fully tax deductible, saving you 19% corporation tax. And then you, as a director, as an employee, pay no tax personally on receiving that benefit from the company. So that's one to make sure you're aware of. Another fantastic one is a trivial benefits exemption. So the best way we tell people to use this is if you're a director of a limited company, you get £300 a year. So for husband and wife, partner, it's doubled. And you can use this in £50 increments. So we say every 2 months, buy yourself a £50 Amazon gift voucher or a store of your choice. As long as you can't then return that voucher for cash, absolutely fine, which most gift vouchers you can't. Use the company card to pay for it, and then you can use that to buy anything that you want. Yeah. So that's £600 a year. So that's a fantastic one to use. And aside from that, it's just making sure that you claim as many costs as possible. So training costs, for instance, they're tax deductible. A lot of people that are just starting out kind of get these and then maybe think, a couple of years later, they've actually got their company set up. You can claim that still then. So with pre-trading expenditure, you can go back 7 years, and any expenses you've incurred within those 7 years, you can claim on the first day you start running your business.
So talk to me about what that looks like. So someone comes to me.
Yeah.
They're signed up for Samuel 365.
Yeah.
They pay £95 a month.
Yeah.
That's £1,000 a year.
Yeah.
How can they claim that back?
So essentially, say for instance, it takes them a year. Say for they've got other stuff going on. A year later, they actually make the move. They find a property. They start getting income, or they set the limited company up. All of those £95 a month, for tax purposes, are treated as if they incurred on the first day their business started trading.
Incredible.
So
I actually didn't know that.
That's a good couple of £1,000s that they can then get tax relief on.
And they've got 7 years, did you say?
Yeah, 7 years.
So basically, if someone does one of my courses,
yeah,
and they pay, what about if they have to come to a course? What about the hotel bill?
Yep, so hotel.
What about the dinner that they had in the evening?
Yeah, so as long as they had to stay overnight or it's something out of their ordinary
Right.
course.
So someone comes to my training course.
Yeah.
They book a hotel. They have a nice dinner in the hotel. They pay £100 or £1,000, whatever, for the course.
Yeah.
And then they don't make a success of property, but they keep the receipt. And then the following year they don't. And then the following year they don't. And then the following year they don't. And then finally, after 6 years,
Yeah.
they set up a company and start making some money. They can then go back, take the receipts and for the course, and claim that back. 100% tax deductible.
Yeah, absolutely right.
Dude, that's awesome.
And anything else they've incurred, so a lot of people get websites, flyers, D2V vendors that they're trying to source, all of that kind of stuff as well. That's all included in that.
One of the interesting things is we always get gifts for our tenants.
Yeah.
So we'll get like them a Christmas, whatever it might be. Amanda, my wife, sorts it out. And I always say to my wife, it's really good to do that because you keep the tenants happy and you show that we care. And I thought, I wonder if it's tax deductible.
Yeah.
And I looked into it, and lo and behold, it is.
Yeah.
I think I can't remember I think it's up to 100, I don't know, you probably don't know off the top of your head, but I think it's like up to £100 or something.
Yeah.
You wouldn't be able to get them a car.
Yeah, it's basically something small enough that...
Yeah. Like, if you want to get them some flowers and chocolates or whatever, you can give it to them as a tax deductible gift.
Yeah. Offset against your profits. So.
And most people just spend it on their personal profits.
Yeah, well, even if you did spend it out, say you spent it out of your own pocket, if you use your own card to pay for that stuff, that would actually go into your director's own account. So as long as you've still got the receipt for that, what will happen is you can still claim it as a business expense, and then your company will owe you the money. So say, for instance, you spent £100 on stuff.
Yeah.
You've got 10 tenants, 20 tenants, that's £2,000 potentially. Your company would then owe you that. So that would go to your director's loan account. And then say, for instance, you didn't want the money now, but you might want it later. A year down the line, that company can then pay you £2,000 tax-free because it owes it to you from those original expenses.
Amazing. Talk to me a little bit about when you're doing a property up.
Yeah.
So you're buying a property, you want to refurb it. How does that work from a tax perspective?
Yeah, so from a tax perspective, it's one of those difficult grey areas because there's a lot to it and you have to look at each transaction to see whether it's capital or revenue.
Yeah.
So capital, that means it's improving the asset. So if you bought a really kind of rundown house, no roof, no nothing like that, all of that expenditure that you incur in order to get that property in a condition when it can be let out, that's usually deemed capital. So you only get tax relief on that when you come to sell the property later on down the line.
Yeah.
Whereas revenue expenses, they're expenses that you incur on a day-to-day basis in order to earn revenue.
Yeah.
So what you want to do where possible is get as many expenses through as revenue so that you get a tax relief now rather than probably never, because most people don't want to sell their properties.
Okay, so give me some examples
Yeah.
of revenue expenses. Let's say it's been 5 years and the carpets are a bit shabby.
Yeah.
And you replace the carpets. Is that revenue?
Yeah, so replacing carpets would be revenue. As long as it's a replacement. Actually, when the first time you put carpets down, so if you've got a brand new house, no carpets down, but you put them down, that's actually capital, but replacing carpets is allowable.
Yeah.
Replacing windows as well, that's a revenue expense, boilers, kitchens as well, as long as there's no improvement. So if you've got kind of an 8-unit kitchen and you buy to let and you put another 8-unit kitchen in, that's revenue. But say, for instance, you knock a wall through, make it to a kitchen diner, and you've now got a 12-unit kitchen, we'd have to apportion it because only a certain amount of that would be revenue. All of the stuff that makes that kitchen better, more valuable, would actually be capital.
Right, right. So, as well, I don't like sometimes to talk about what I claim back as tax deductible and stuff because I don't want it to become about me and get a big spotlight on me. Like I wouldn't say, welcome to my studio, it's my lounge. Yeah. but you know, I mean, look, it's real. I claim, you know, I rent, as you know, several houses in this area. And there's certain rooms that they could be classed as a dining room, but they also could be classed as a boardroom.
Yeah.
And I claim back as much rent as I can.
Yeah.
I claim back as much rent as I can, and you can do that.
Yeah, essentially, as long as you're using this room for business purposes, if you apportion it, say for instance, use it 50% for personal use, 50% for business, you can then divide the total amount of rent you're paying by the number of rooms. And if you're using, say, this room 50%, you can claim 50% of the rent you effectively pay for this room.
Yeah.
And the same with all the other rooms as well.
Yeah, which is great. So I think it's about, you know, you've got to make sure that everything you're doing, you do have professional advice.
Yeah.
Because it could be, and I've had the VAT man and the tax man, the revenue check our books and come. The VAT man came. It was a few years ago now. The really funny thing is we got a full report and not investigation, but the VAT man came and it ended up that he owed us £150. So I was like, boom, so because you need to be very, very careful about this stuff. But I think it's about just knowing what you can and what you can't do, and then doing it properly. So okay, talk to me a little bit about, you've set up a limited company.
Yeah.
You've started trading, making a bit of money, because a lot of my students, they'll set up a company, maybe deal sourcing, rent to rent, whatever. Then they'll come out of their job.
Yeah.
How do you pay yourself through your limited company?
Yeah, so essentially there's 3 main ways we like to say you can pay yourself. So the first is taking a salary. So as your limited company is separate from you, you can't just take the money from the business bank account. You basically need to do it in a formal way. So the first way is as a salary. So you'll get pay slips, you pay income tax, national insurance on it, just as you would your normal employment income. We recommend people do this for a small amount of income. For this current tax year, it's about £9,500. If you are looking to pay yourself, take that out from your limited company as a salary.
And do you pay tax on that £9,500?
Yeah, so you'll pay income. Well, for most people, if say for instance you've got no income for the tax year, that would fall within your personal allowance, being 12,570. So that would be tax free from an income tax point of view. There'd be a couple of quid worth of national insurance on it.
Yeah.
But then all of that salary is tax deductible in the company.
So basically the first amount of money that you make, if that's your only income, and that's about 12 grand, you're not going to pay any income tax on that.
Yeah, that's right. Completely tax free. Your personal allowance.
Okay, so that's why you're going to pay yourself a small salary.
Yeah.
To avoid having to get clobbered with tax.
Yeah, that's right.
Okay.
Then anything over and above that, it makes sense to take either as interest. So I know we mentioned director's loan accounts early on. So a lot of people, when they first start their business up, they put a lot of money in to get it going, deposits of properties, personal savings. Like I said earlier, because you're a limited company yourself, completely separate entities, you can actually charge your limited company interest. So if you put 100k in, you'd only do that to get a return back from somebody. If you lent that to a third party, you're probably charging 10, 12%. So you can actually charge that to your own limited company. So on that £100,000, you could pull £12,000 out as interest, which you'd receive by paying a little bit. You pay income tax on it, say 20%, and then that's an allowable expense in the company, which means you're going to get 19% corporation tax relief. So you pay 20% tax on it if you're a basic rate taxpayer maximum. 19% corporation tax relief. That's 1% tax that you've paid on almost an infinite amount of income, because as your director's own account keeps growing, you can charge as much interest as you want.
Yeah, that's great. Okay, so in terms of tax efficient property investing, because this is a property investment channel, buying through a company can be tax efficient. You can avoid Section 24, but it just depends on the scenario.
Yeah.
One of the things that we have done a lot of, and also many of our students have, is serviced accommodation, which is like tax paradise, because there's so many advantages to that strategy from a tax perspective. Could you just talk me through what that looks like?
Yeah, so service accommodation, a lot of people actually don't know this, but service accommodation is better done in probably your own name on LLP. It's one of the better ways to do it, simply because you can get something massively valuable called capital allowances on service accommodation. So that applies to all the integral features, the pipe work, any AC units, all that kind of stuff. You actually get tax relief on that. Usually this is between, say, 20 and 30% of the property value. So if you're buying a £200,000 house using service accommodation, that could easily be £60,000. And what this does is it's a tax allowable expense. So if you will not pay a penny on tax until you've earned that £60,000 in profits from your SA business, because you've claimed those capital allowances. And on top of that as well, when it comes to sell the property, you can get business asset disposal relief. If you want to give it away, you can get rollover relief. So there's loads of extra tax deductions available. And the biggest one, of course, would be Section 24 does not apply to furnished holiday let service accommodation. So you can still deduct all of your mortgage interest.
Right. So it's fantastic from a tax perspective, and also from a cash flow perspective.
Yeah.
Because people think, well, if I rent out service accommodation, I'm going to make loads more money, but they don't have to pay loads more tax. But actually, no, you can make loads more money and you're probably going to pay less tax.
Yeah, 100%. I was speaking to somebody the other day that said they've been using their property as service accommodation, so they've been doing it, but they've still been doing their tax return, because they do their own tax return, as if it's a property business. So they're still not claiming their finance costs. And they're still not getting any of the benefits of running their property as service accommodation, but they actually are running it as service accommodation. So speaking to that client, it was a massive kind of mindset shift for them, because it's going to save them thousands in tax just by actually getting those tax benefits that are available. Yeah,
really. That's why it's so important to be educated. And to know what you're doing. So for me, Josh, I've got, as you know, a large property portfolio. I built up my portfolio quite a long time ago. First house in 2009. They didn't bring in Section 24 until much later. Right? So most of our houses I own in my personal name. And now I'm doing more development deals. I'm not like accumulating properties like I used to. However, one of the things we looked into is, should we move our personal properties into a company? Now, I came to the conclusion that we probably shouldn't. But I get asked a lot from my students, should we move our properties from our personal name into a company? I'm sure you get asked that question as well. What would you say?
So I suppose it depends on how many properties you've actually got. So there is a way to move your properties into a limited company, but it all depends. There's a famous case called the Ramsey case, which basically said that if you work more than 20 hours a week in your property business, you qualify for incorporation relief, which allows you to move the property business, the properties into a company tax-free. Because otherwise, if that's not available, it's a market value disposal. So say, for instance, you've got a capital gain on there, house prices have gone up, you would pay tax on selling the properties from yourself to your limited company, but you've not actually got the money from that. So you've got to find the money somewhere to pay this tax bill. And also there'd be stamp duty payable as well, based on the full market value.
That was the killer for me.
So if they're not available from a tax perspective, it doesn't really make sense. That said, there are ways around it. So we've got, if you work at least 20 hours per week in the property business, which tends to be, most people say about 8 properties you need in order to be able to really back that up. You can incorporate without there being any capital gains tax. And also, if you run your business as a partnership, so if you've got a husband and wife running their business together as a property partnership, you can actually do, as long as you do it for, they say, about 3 years, so that you've got a justifiable partnership, you can then incorporate that into a limited company without any stamp duty either. So it is possible for people with large enough portfolios to get from their own name to a limited company completely tax-free.
I guess it also depends how badly you're being stung and that was another thing is a lot of our properties are HMOs.
Yeah.
So the rent is high.
Yeah.
We were paying like £200 a month on the mortgage.
Yeah.
The rent's £1,500. It's not.
Yeah.
Whereas if you've got people that have got a lot of single-let properties where maybe their rent is 800, but their mortgage is 500.
Yeah.
And they've suddenly wiped out their profit.
Yeah.
So some landlords are in a position where they're losing money.
Yeah, they actually have to top up the extra money.
So it's like, so I guess the answer would be probably then it depends.
Yeah.
Depends on the size of the portfolio. Look at it, with your help. But how much it's going to cost to move across.
Yeah.
And then we looked at how much we're actually going to save.
Yeah.
And it didn't make much difference.
Yeah.
So it wasn't worth the hassle.
Yeah, because the fees to get it across, they are expensive. And if you've got kind of low loan to values, very minimal mortgage payments compared to the high rental income,
Yeah.
it's probably not going to make sense.
Yeah.
And for most people watching this, if you've got 1 or 2 in your own name, 9 times out of 10, it does not make sense to transfer that to a limited company.
That's what I usually tell people. I say,
Yeah.
if people come in, I usually say, probably doesn't make sense,
Yeah.
but speak to an accountant. So if people want to get in touch with you, I would probably suggest that they go ahead and follow your YouTube channel,
Yeah.
where they can find more videos and more content. So what would be the best way to do that?
Yeah, so literally just type in Joshua Tharby, YouTube first and foremost. We've also got Instagram, Facebook, we've got a Facebook group, so many different ways. But yeah, just head to the YouTube channel and you can find out more information there.
Awesome. Thanks so much for coming on the show. I'm sure people are going to be very enlightened and appreciate your time.
Yeah, it's been an absolute pleasure. Thank you for having me.
Awesome. So there we have it, folks. Joshua Tharby in the house, sharing top tax tips. I think this video is going to be one of the most valuable videos on YouTube right now. So share the video, share it with all of your property friends, because people need to know this stuff. Because so many people are losing money on taxes when they don't have to. So share the video around in your WhatsApp groups with your friends. Hit the like button. If you didn't like Josh, or if you thought he was a little bit of a jerk, that's okay. You can hit the dislike button. And I know you're not going to do that though. Don't forget to subscribe. You can subscribe right over here. And if you want to see more videos like this, you can do that right over here. And I'll look forward to seeing you guys next time.